Welcome to 4 Tips for Business Owners from the CFO's Perspective. Hello, I'm Larry Chester. I worked as a corporate CFO for 25 years before starting my consulting practice a little over 13 years ago, CFO Simplified. CFO Simplified provides part-time CFOs for small to mid-sized companies in nearly every industry. We help companies with cash flow forecasting and management, profitability improvement, and something that I like to call financial statement visibility, which means when you look at your financial statements, do you see things that allow you to make changes today that affect profitability tomorrow? Now I have a team of full-time CFOs that work for business owners just like you, anywhere from 2 days a week to 1 day a month. In addition, we have a bookkeeping division with a team of QuickBooks bookkeepers for those companies that want to have someone else worry about their day-to-day bookkeeping chores. Primarily, we provide fractional CFO services for middle market companies throughout the United States. If there's something that you have a question about, just send me your question in an email after the presentation, and I'll send you a response as quickly as I can. Here's our agenda for today. We're going to be covering 4 topics. I'll be talking about cash flow, profitability, internal controls, and financial reporting and KPIs. Hopefully you'll find some of these hints help you in running your business. First, let's talk about cash flow. A number of years ago, I had a client who I chased for nearly 3 months after his lawyer introduced us. One Tuesday, he called me and said, "You have to start working for me tomorrow." So I arrived at his plant Wednesday morning and he ushered me into his office and closed the door. He said, "I'm so glad that you're my CFO now. Your first job is to figure out how we're going to cover payroll on Friday." Wow. Well, we did it. But apparently he thought that I could fix his cash flow issues by turning on a magic faucet. Well, that's not how cash flow works, even if we wish it was. Cash flow is how much money you have in your bank account right now. How much money can you get access to? That's different from net income, which is the number at the bottom of your income statement. That doesn't tell you what you have available to spend today, tomorrow, or next month. Only a cash flow forecast can tell you that. So here's a few hints to help you manage your cash. Number 1, develop a cash flow forecast. This will track the cash that you expect to receive on a weekly basis and allow you to make a list of the money that you expect to pay out during that same period. I know some companies like to do this on a monthly basis, but that's not going to be quite as helpful. You need to look at it weekly so that you can plan. You have major expenditures like payroll, rent, lease payments, insurance, and don't forget about your supplier invoices. The cash flow forecast tells you if you're going to have money for your critical payments and also lets you plan on what money you're going to have after you make those payments. Second, collect your receivables. I know that sounds obvious, but your cash availability is dependent on people paying you. If you're casual about getting paid, people will just take advantage of you. So don't be shy. Send out statements or call your customers to make sure that they're going to pay you on time. If you're running short of cash, reach out to your biggest customers to make sure that the invoices you're expecting payment on are in their system and ask when they're expecting to make those payments. Third, use your credit line to cover short-term cash shortages, not operating losses. You should actually only be using about 50% of your credit line on a regular basis. If you're using 90% of your credit line all the time, then what are you going to do when you really run short of money? Next, let's talk about profitability. I was working with a client that was showing a loss on a monthly basis. I felt that there had to be a problem with the pricing that they gave their customers on the jobs that they quoted and completed. So I went to the job estimator and asked him whether he had ever compared the estimates that he gave to the final cost of the jobs that they did. He said, "Well, of course, and they're always right on." "Oh, really?" I said. "Yes," he said. "I've been doing this for more than 10 years, and I'm really good at what I do, and our estimates are always right on the money." So when I left his office, I went to the IT department and asked the IT manager where the system got the standard costs for each project that they produced. He said, "Well, from the estimates, of course." So the comparison that the estimator was using was neither helpful nor accurate. It was just a self-fulfilling prophecy. We found over the years that many companies don't really understand their costs and therefore have a hard time predicting their final profits. Here's how to avoid making that mistake. Track all of your construction, manufacturing, or acquisition costs. The costs include not just labor hours and materials, but your overhead as well. Your trucks, the staff in your plant that sets up the jobs and collects the materials that you're going to use, a portion of your rent and utilities. If you provide services and not manufacturing, then consider the hourly costs of not just the person providing the services, but other people on staff that support them as well. If you don't really understand all of your costs, how can you truly understand what your profit is? Second, I'm expecting that many of you have your taxes done on a cash basis, but no matter how your taxes are calculated, always run your monthly financial statements on an accrual basis. I don't care if your company is doing $250,000 a year in sales or $250 million a year. It's important that you make sure that your sales, the expenses related to them, are all properly aligned every month. That's the only way you can make sure that you're looking at complete and accurate numbers. Third, make sure that your prepaid expenses and your accrued expenses are properly reconciled every month and that you have a report that details what's in each account. You may spend $24,000 a year on insurance for your company, but in actuality, you're really only spending $2,000 a month. So you should be accounting for it just that way. Otherwise, during that 1 month that you pay the insurance bill, your profitability is going to take quite a hit. There's no reason for that to happen. Spread it out over the year the way it should be. For our third topic today, let's talk about internal controls. A prospect called me and said that his office manager was such a critical part of his company that he was afraid that if anything happened to her, his company would just sink. She did his invoicing, his cash receipts, his accounts payable, and his payroll. She did the month-end close, and even if she was on vacation, she came back into the office to do all of those things. She was truly indispensable to him. So he wanted someone to backstop her in case anything happened to her. After I interviewed with him and the office manager, I found out that mysteriously enough, my emails to him had become blocked. When I called him and asked him about it, he told me that he didn't do it, and he was very confused. I know that his office manager managed not only his business, but his emails as well. I wonder what happened there. She was obviously very comfortable with the way things were working out, and she didn't want someone new sticking their nose into her business. I found over the years that business owners are very trusting of their long-term employees. If you want to see an interesting movie on this topic, watch Bad Education, starring Hugh Jackman and Allison Janney. It's a true story, eye-opening, a very good movie, but it's truly a story about a classic case of internal fraud. The important thing here is not to distrust everyone in your company, but to put policies in place that keep honest people honest. So what are some things that you can do to help assure that you aren't going to be a victim of internal fraud? Well, first, provide segregation of duties in your accounting department. Have one person do the invoicing and another handle the cash receipts. Have one person do the purchasing, but another person issue accounts payable checks. Have one person calculate payroll and another one enter it into the payroll system. You may not have enough staff to do all of these things, but you get the idea of what I'm talking about. Second, limit the number of people that can sign checks. If you're the business owner, you should sign all of the checks that are being issued. If you do electronic banking, you should get a listing of the payments to approve, and then you should get a listing of the payments that were issued. This allows you to make sure that you've seen all of the disbursements. Third, review your bank statement and bank reconciliation on a monthly basis. This will show every single withdrawal from your operating account. Be sure that you recognize the reason that money was taken out of your account each and every time. If you don't know why, then ask. Here's our fourth topic. Let's talk about month-end reporting. I walked into a new client's office and asked him to show me his last month's reporting package. He gave me some reports and I asked him how much of that he really looked at. He told me that he looked at 5 all-important numbers. He looked at sales because it told him whether his company was growing. He looked at gross margin because it told him how much profit he was making on sales. He looked at sales expense because it told him how much it would cost him to acquire new customers. He looked at operating expenses because it told him what his overhead was. And then he looked at net income because it told him how much money he could take home. Then he leaned back proudly in his seat. So I asked him, after looking at all those numbers, what changes are you going to make today that will drive profitability to the bottom line? He didn't have any answers. Not surprising, because those numbers are good for an overview of how your business is doing, but they're not sufficient to really manage the detail of any business. Everything that happens in a company flows down to the financials, but you need to be able to see the detail to understand what's actually happening in your company and make changes that have an impact on not only operations, but on profitability. So I apologize to those of you who are well attuned to this, but I thought it might be good to give just a little bit of background. There are 3 basic financial statements that are the key to keeping your company on track. You should be familiar with all of them. The balance sheet tells you the value of your company at one particular point of time, like at the end of a month or at the end of a year. Your income statement gives you the financial results your company achieved over a period of time, like during an entire month or over an entire year. The statement of cash flows tells you where your company's money came from and how it was used during a period of time, which is why it's sometimes called sources and uses of cash. Now, my experience is that most business owners are fairly familiar with the income statement, comfortable with many aspects of their balance sheet, and generally don't know what to do with the statement of cash flows. But in addition to those 3 reports, there are some other reports that you should be looking at that tell you the detail of what's happening under the covers of your business. And the values of these reports should be matched to the balance sheet to verify the balances that are there. Here are just a few. Your accounts receivable aging tells you not just what's outstanding, but who is not paying on time. The accounts payable aging tells you how current you are in paying your bills. The inventory value report tells you the amount of inventory you have on the floor, but also can tell you the amount of obsolete or unused inventory that you're holding. An item or project profitability report tells you where you're making money and where you could improve. Comparing job estimates to actual results confirms how accurate your estimating is. A customer sales report would tell you what your customer concentration is and how much each of your customer sales have changed in the last year. Plus, you should be looking at a comparison of current numbers to budget, a comparison from current numbers to last year, a trend line analysis so that you can take a look at trends in sales, customer concentration, profitability, inventory levels, and any number of KPIs that you're looking at. But just as important as the financial reports are the KPIs, those key performance indicators. These should be used to measure not just the company's financial performance, as in margins, profitability, and financial ratios, but to measure the operational performance of the company as well. And it can be used as a means of setting goals and standards and then tracking the company's performance progress towards those goals. Of course, make those goals and the KPIs available to the company at large so that they can see how they're doing as well. And there are many KPIs for companies, and there are as many KPIs as there are products being sold. Determine which measures are important to you. There are as many KPIs as there are companies and products being sold. Determine which measures are important to you. You can measure how your company has performed in the past, but it's also important to measure things that are leading indicators of how your company will do in the future. Just as an example, if you take a look at your company's sales, those aren't just the result of the phone ringing today. It's the result of the outbound calls made by your salespeople, of the advertisements or social media posts that you've done, or the marketing emails that you've sent out. There are as many KPIs as there are companies and products being sold. Determine which measures are important to you. You can measure how your company has performed in the past, but it's also important to measure things that are leading indicators in how your company will do in the future. Just as an example, if you take a look at your company's sales, these aren't just the result of your phone ringing today. It's the result of the outbound calls made by your salespeople and the advertisements or social media posts that you've done, or the marketing emails that you've sent out. Sales managers look at these numbers all the time. 100 phone calls will reach 20 people. That will result in 10 presentations. That will result in 5 quotes being issued. That will result in 2 sales. So how can you tell what your sales are going to be in 4 months? Well, measure how many outbound phone calls are being made this month. If you can find those kinds of leading indicators, those KPIs are important in helping you predict what you need to do to get the results that you want to achieve. In summary, each of these tips are about business from a CFO's perspective, and they are all elements that a part-time CFO can help you with in your business. But they're also things that you can manage in your own company. These are just a few of the things that we look at when we start working with our clients. Our goal is to help business owners resolve issues that they might find in their companies. We're operationally focused financial executives. We make sure that you have the information you need to understand how your company is operating. We work with you to optimize your time and improve your company. Visit our website at CFO Simplified for helpful resources and timely blog articles. For a full PDF version of our cash flow do's and don'ts, email me at larry@cfosimplified.com. Here's my contact information. I look forward to hearing from you if you have any questions or issues. Thanks so much for your kind attention.